speaking.
Whenever speaking.
Okay.
So it just.
Morning, and first of all, I'd like to ask everybody to rise as we say the prayer and the pledge. I now call the Committee on Small Business to order. Without objection, the Chair is authorized to declare a recess of the committee at any time. The committee is here today to hear testimony about proposed changes to the 7A loan program and how it will affect lenders and borrowers. Thank you all again for being here to testify today. I now recognize myself for my opening statement. I want to welcome you all again in today's hearing, which will focus on Small Business Administration's changes to the 7A loan program. At last week's full committee hearing on this vital issue with the SBA, many of our questions went unanswered. So I hope today we can serve as a constructive conversation on how these changes add unnecessary risk and threaten the 7A program's long-term integrity. Just one day after hearing our hearing last week, Associate Administrator Patrick Kelly, who testified before us, was dismissed from the agency. While the circumstances around his departure are still not clear, there are two logical suggestions. First, his contempt for the basic congressional oversight was apparent, and the SBA did not think his behavior was appropriate for the agency. Or second, he submitted his resignation months ago, and the SBA decided to send someone to testify on these major rule changes, knowing that he could be parting ways with the agency shortly after, kind of a lame duck witness. Whichever scenario is accurate, both of these are extremely concerning as we do our congressional due diligence over these new rules. Members of this committee on both sides of the aisle still have unanswered questions regarding these changes and are concerned that the SBA is continuing to move forward without the leadership in place to help make these transitions as smooth as possible. This concern is not only bipartisan here on this committee, but also is shared by our colleagues in the Senate. Yesterday, I, along with Ranking Member Velasquez, Chairman Cardin, and Ranking Member Ernst, joined a pen letter together to Administrator Guzman, saying that it is our collective belief that at the very least, it's best to find a new permanent head of the Office of Capital Access before we begin these changes and before they go into effect. Finalizing the proposed rule represents the most significant changes to the program in decades, and I hope that we will be able to have a productive discussion about how the changes to the lending criteria will add more risk to the taxpayer-backed loan portfolio, and how these changes will weaken the credit elsewhere test and take the SBA away from being the lender of last resort. In addition, I hope to discuss SBA's capabilities as a regulator and if they are properly equipped to take on this increased responsibility, and also if the proper guardrails have been installed since the agency let billions of taxpayer dollars be stolen from the pandemic loan programs. For decades, the 7A program has been operating on a bipartisan basis to help business get off the ground with their capital needs. Unfortunately, I'm afraid that these changes will lead to a greater default rate that will rely on the program to continue to be subsidized by Congress in order to remain in existence. I'm not alone in raising these concerns. The SBA's Inspector General himself testified before this committee and noted that there are significant challenges that the agency will face in managing the increased loan volume going forward, as well as the significant shortages of staff within the department that oversees this program. So we cannot allow the SBA to get these rules wrong. I will once again call on the Biden administration to slow down until we can properly determine how these changes will work in practice. And without objection, I would like to submit statements for the record from ABA, QNA, and NAFQ regarding these rule changes. I want to thank you all again for being here with us today, and I'm looking forward to a more constructive conversation today. And with that, I will yield to our distinguished ranking member from New York, Ms. Velasquez.
Thank you, Mr. Chairman, for bringing us back together on this important topic. But I would like to start by just entering to the record the fact that money from taxpayers were stolen because the Trump administration didn't put in place the guardrails that were needed in order to protect taxpayers' money. So I want to be fair in terms of that qualification. In just 1 week, there have been quite a few developments, so I look forward to our discussion. As we have already detailed, the SBA issued 2 final rulemakings that have substantial implications for critical lending programs. Not only do the rules make significant modifications, the interplay between them and the programs to which they apply are vast and complicated. Not every program will be impacted in the same ways. Last week, much of our hearing focused on the 7A program, and rightly so, because it is the agency's flagship initiative, providing nearly $15 billion in loans to small firms all over the nation. But today, I am hoping to hear what these rules mean for another program, the 504 CDC Loan Guarantee Program, which is administered through nonprofit CDCs. The 504 program provides long-term fixed-rate financing for major assets such as land, buildings, and equipment. Through a 100% SBA guaranteed debenture, the CDC provides up to 40% of financing, while a third-party lender provides at least 50%, leaving the applicant with at least 10% of the financing. Last year, the 504 program delivered over $9.2 billion in capital access, and so far this year is nearing $4 billion. As one of our own members has stated in previous hearings, the 504 program can be slow and complicated, making it ripe for an improved, streamlined process. The affiliation rule helps bring some improvements that are welcomed by the industry and borrowers alike. The disparity between the rulemaking's application to the SBA lending programs highlights just why this committee is taking a deep dive into these policy changes. It is incumbent upon us to look at every aspect of what the details truly mean and their potential consequences, good or bad. SBA instituted these rules to address persistent gaps in access to capital as part of the Biden administration's broader economic agenda. As I have continuously stated, increasing access to capital for underserved entrepreneurs remain my top priority. But I will be remiss in my obligation to borrowers and program integrity if I didn't do my due diligence. And that is why we are here again today, to listen to the industry stakeholders and understand their views of the rules on the programs they participate in. Ensuring that businesses owned by women, people of color, and underserved groups have the resources needed to succeed is an important goal, and I look forward to hearing another perspective of SBA's actions. I remain committed to filling the gaps in the market in a bipartisan and thoughtful way, and pledge to work with the SBA, stakeholders, and my colleagues on the House and Senate committees to find a solution. Thank you, Mr. Chairman. I yield back.
Thank you, Ranking Member Velasquez, and I will now introduce our witnesses. And it is my pleasure and privilege to introduce our first witness, Mr. Tony Wilkinson. Mr. Wilkinson has served as the President and CEO of the National Association of Government Guaranteed Lenders in Frisco, Texas, for more than 30 years. And prior to joining NAGGL, Mr. Wilkinson spent 13 years with the Stillwater National Bank as Senior Vice President, was responsible for the bank's SBA lending activities. Mr. Wilkinson is a graduate of Oklahoma State University, home of the Cowboys, right? And Mr. Wilkinson, thank you for being here today. We look forward to the conversation ahead. I now recognize Mooser's not here, and he was going to introduce you, Mr. Kasar, so I'm going to do it in a Texas way, okay? All right. Our next witness is Mr. Ami Kasar. Mr. Kasar is the founder and CEO of Multifunding LLC located in Ambler, Pennsylvania. Mr. Kasar has dedicated the last 2 decades of his career to ensuring that business owners and entrepreneurs get the best possible financing to grow their businesses. He knows far too well the impact that poor financing choices have on the ability for a small business to grow, In his work as a public speaker and as a founder and CEO of Multifunding LLC, Mr. Kasar has helped thousands of business owners and entrepreneurs structure their debt to optimize growth and in turn help to create tens of thousands of jobs. Mr. Kasar is a graduate of Brandeis University and the University of Southern California, where he received his master's in business administration. Mr. Kasar, thank you for being here today, and we look forward to the conversation ahead. Next, our next witness is Alice Frazier. Ms. Frazier serves as the president and CEO of Bank of Charlestown in Charlestown, West Virginia. She also has recently been appointed to the Board of Directors of the Federal Reserve Bank of Richmond. Including her current position with BCT, Ms. Frazier has over 32 years of local banking experience, including with Cardinal Financial Corporation as Executive Vice President and Chief Operating Officer, BB&T as Senior Vice President in Loudoun County, and Middleburg Financial Corporation as Chief Financial Officer and Chief Operating Officer, which is where Ms. Frazier began her banking career. Prior to that, she worked for 4 years in public accounting with a national and regional firm. Ms. Frazier is a graduate of Stonier. Is that how to say it? Stonier? Stonier Graduate School of Banking and Radford University. Ms. Frazier, thank you for being here today, and we look forward to the conversation ahead with you. And I now recognize the ranking member from New York, Ms. Velasquez, to briefly introduce our last witness appearing before us today.
Thank you, Mr. Chairman. It is my pleasure today to welcome back to our committee Mr. Manny Flores, President and Chief Executive Officer of Summer Corps, an SBA certified development company located in Chicago, Illinois. In addition to making 504 loans, Summer Corps is an active lender in the SBA Community Advantage Pilot Program and a member of the National Association of Development Companies, or NADCO. Mr. Flores first joined Summer Corps as a board member in 2016 and was appointed to his current role in 2018. Prior to Summer Corps, he held elected office as a Chicago City Council member and served as director and acting secretary of the Illinois Department of Financial and Professional Regulation. We're glad to have you with us today. Welcome. I yield back.
Thank you, Ranking Member Velasquez, and we appreciate all of you again being here today. Now, before recognizing the witnesses, I'd like to remind all of you that your oral testimony is restricted to 5 minutes in length. If you see the light turn red in front of you, it means you have your 5 minutes have concluded, and you should wrap up your testimony. And if you don't wrap it up, I'll beat on the gavel, and you'll get the idea, okay? So with that, I now recognize Mr. Wilkinson for his 5-minute opening remarks.
Thank you, Mr. Chairman, Ranking Member Velasquez, and members of the committee. Let me start by saying, Mr. Chairman, I agree with your opening statement. In the 36 years I've been NAGL's CEO, I've never seen changes more sweeping and potentially damaging. SBA is removing long-standing underwriting guardrails that have assured prudent lending in the 7A program, while simultaneously adding an unlimited number of non-federally regulated lenders. Worse, SBA will serve as primary regulator for these new entities, a role that it is not equipped for. SBA's stated intent for these changes is laudable: increase access to capital for underserved markets and streamline processes. The lending industry wholeheartedly supports those goals, but the recent rules do not achieve what SBA is setting out to do. And the biggest change between the proposed and final rules, SBA removed any mention of underserved markets from the regulatory language. SBA's data shows that in fiscal year 22, more than 75% of all loans are estimated to be small dollar loans, 68% of all loans going to underserved markets, far exceeding SBA's 43% goal, and nearly 1/3 of all loans going to minority-owned businesses. There's always room for progress, but these numbers don't show the market failure that SBA has described. First, on underwriting, the rules remove guidelines that ensure lender behavior and portfolio performance stay at an acceptable level. SBA has described the new standard as do what you do, leaving it up to lenders to determine what is prudent. I fear that removing these guardrails creates a race to the bottom in credit quality. Today, 7A loans are not funded by taxpayer dollars because current loss rates assure that the borrower and lender fees cover the cost of loans. Removing the underwriting guardrails mean that losses could increase, and Congress either will have to raise fees on borrowers and lenders or provide an appropriation. Otherwise, this program shuts down. A lose-lose. And after throwing out the rule book, SBA is telling the new non-federally regulated lenders, presumably fintech, that they can do whatever they think is prudent. SBA said in 2021 rules that it could not be the primary regulator for more lenders because it lacked the oversight capability and cited increased risk to the agency. Just 22 months later, and with no evidence of changed capacity, SBA has reversed itself. And despite SBA's assertion that it will add just 3 additional regular SBLC licenses, the truth is it is just 3 for now. The rule doesn't have any limits. And SBA is also adding mission lenders currently participating in the Community Advantage Pilot Program as SBLCs, which is more than 100 entities. The capacity and resources of SBA's oversight functions both fall short. Funding has been stagnant for nearly 10 years. There's a failure to even meet current oversight requirements, and the IG identified staff vacancies of 40%, just to name a few concerns. But even with more resources, SBA still lacks the regulatory framework necessary to oversee lenders on an enterprise risk level. This is made worse because the final rule removed the restriction that limited SBLCs to only making SBA loans, increasing the oversight burden significantly. And currently, SBA does not regulate for Bank Secrecy Act or Know Your Customer or even the most basic consumer protections. And the rules go even further. SBA now allows a business to qualify as small, even if it is controlled by a large business. It will be the large business, not the small, that will be the primary beneficiary of an SBA loan. SBA also drastically altered credit elsewhere to nothing more than a check-the-box exercise, inviting fraud like we saw in PPP. And now SBA allows borrowers with significant personal wealth to qualify for loans, flying in the face of the statutory mandate to only give a 7A loan to borrowers who could not get credit elsewhere. Finally, politicizing SBA decisions should concern everyone. Under the affiliation rule, the SBA administrator can now reverse a loan denial. This change allows politics to seep into determining SBA loans. And the biggest concern? The harm to borrowers, particularly the underserved, who would be faced with higher fees, the possibility of receiving loans they cannot repay, and lenders who have no federal regulator that ensures consumer protections. This Treasury Department, Mr. Clyburn, House Oversight Committee, the IG community, and more all point out significant concerns with the concepts in the underlying rules, yet SBA has not heeded any warnings. Lenders are not concerned about competition, nor is this about being anti-fintech, but SBA is not inviting fintech into the program we all know and trust. SBA is inviting fintech into a very changed program devoid of guardrails. I'm profoundly opposed to imprudent changes that could harm underserved markets and damage the 7A loan program. Participating in a government program requires responsible stewardship, especially when the current portfolio is nearly $107 billion in outstanding principal balances, with the government liable for roughly 75% of that. Congress should require strong guardrails when the federal government is the backstop. While SBA could change course, I see little evidence it will, especially when it has repeatedly ignored congressional and industry concerns. I implore you to legislatively act because the future of this program might very well depend on Congress reversing these rules. Otherwise, the program that fuels Main Street America will be in jeopardy and our most vulnerable small businesses harmed. Thank you.
Thank you. Right on time. Appreciate that. Next, I'll recognize Mr. Kasar for his 5-minute opening remarks.
Thank you for the honor of testifying today to share my thoughts on the changes to the SBA program that deeply concern me. My name is Kasar, and I'm the founder and CEO of Multifunding LLC, a loan brokerage and consultancy company based in the suburbs of Philadelphia. Since 2010, my team and I have heard the stories of thousands of entrepreneurs over the years. In our work, we strongly recommend the SBA 7A program and have helped borrowers receive nearly $400 million of 7A loans nationwide. There are 3 primary points I want to leave you with today. First, traditional SBA 7A lending has few similarities to the EIDL program or the Restaurant Revitalization Fund that we heard about last week. Secondly, when entrepreneurs take loans without a clear path to pay them back, there can be devastating consequences for both the lenders and the entrepreneurs. All of the proposed SBA changes will make it much easier to get a loan, leaving many to take loans before they are ready for them. And finally, if you make wholesale changes to the SBA 7A program all at once, it will be impossible to understand the impact of each Restaurant Revitalization Fund, which is a common thread of testimony in front of this committee last week. The Restaurant Revitalization Fund was a grant program. It did not issue loans, and recipients did not have to repay the grants. Therefore, comparing this program to the 7A program is nonsensical to me. The EIDL program is a story that requires unpacking. First, $378 billion was lent to 3.9 million small businesses without proof of economic injury. The repayment data has barely started to come in. That said, I suspect we will learn a lot from EIDL loans about what happens when you lend money to business owners who don't have a clear plan to pay it back. And this is what I fear will happen if we simplify SBA lending. In this spirit, I want to share a story with you. One night during the pandemic, I was asked to teach a virtual SBA class for a female entrepreneurship group at an African-American church in Philadelphia. About a dozen women who were trying to get side hustles off the ground attended. As the session began, I quickly realized that the last thing these entrepreneurs needed was a loan. You see, like many entrepreneurs, they thought they needed more money to get started than they did. But in every case, there were far less expensive ways to get their concept off the ground than they thought. One woman wanted to start a business baking desserts for restaurants that didn't offer them. She was convinced she needed to borrow $50,000 to open a kitchen. She had yet to consider that she could prove her concept by baking in her home kitchen or renting a kitchen during off hours at a local restaurant to get started. But here's the thing. If an unregulated fintech lender offered these budding entrepreneurs an SBA loan that would land in their bank accounts in a few days, every one of these entrepreneurs would jump on the opportunity. Is that what we want for the SBA program? In today's world, borrowers write business plans, build projections, and make business cases for their needs. They have to have their books in order. Now the SBA wants to throw much of this out of the window. It is a recipe for disaster and will lead to much higher delinquencies, in my opinion. And a delinquent debt to the United States government is not a good mark on a budding entrepreneur's resume. I'm all for change, but you take significant risk if you make too much change too quickly. Broadening access to capital is a worthy goal. But now the SBA proposes changing too much too soon in an uncontrolled environment. If all these changes go forward, as it looks like they will, I predict we will return to this room in 2 years to try to explain the growing default rates. And the problem will be we won't be able to understand the root causes because of all the vast changes being made all at once. I remember some one-on-one lessons from science class in high school. If you're going to try an experiment, test one variable at a time. You cannot read the results if you try everything at once. The checks and balances in the SBA system can be exceedingly frustrating, but they help borrowers and lenders in the long run. We're in the business of issuing loans insured by the U.S. taxpayer. This is not a responsibility we take lightly. With these simultaneous changes, we risk blowing up a long-standing healthy program like the SBA that positively impacts our economy. I implore Congress to slow down the SBA train that has already left the station and create a more cautious path for the SBA in the future. Let's evolve and grow and try new things, but in a measured and thoughtful way. Thank you very much.
Thank you. Good job on the timing. And now I'd like to recognize Ms. Frazier for her 5-minute opening remarks.
Chairman Williams and Ranking Member Velasquez and members of the committee, I am Alice Frazier, President and CEO of Bank of Charlestown, a $790 million community bank serving the markets of West Virginia, Maryland, and Virginia. I testify today on behalf of the Independent Community Bankers of America, where I am chair of the Bank Operations Committee and a member of the board. My bank has been an SBA lender for over 40 years, and I'm proud to say that more than half of the SBA loans over the past 18 months were made to minorities or women borrowers. And we share with this committee the goal of preserving and protecting the integrity of the SBA 7A program, while continuing to make prudent loans to smaller and underserved businesses. The new SBA rules, which were rushed through the process without any input from Congress or industry, will undermine this critical goal. And we recommend the agency hit the pause button, convene a working group of existing SBA lenders to determine how we can better align the program with the SBA mission of reaching the smallest businesses and entrepreneurs. Current lenders know where the challenges lie and should be given the opportunity to craft a program that works better. We believe the SBA's new Small Business Lending Company rule, which will admit non-bank financial technology companies, or fintechs, to the 7A program, is a serious threat to its integrity. And moreover, the new affiliation rule and revisions to the SOP appear to be specifically designed to accommodate non-bank fintechs. Online-only lending can never be a substitute for on-the-ground community bank lending. The business model of a non-bank fintech, that snap approval and rejection of a loan and quick disbursement of funds, is often not in the borrower's best interest. We have a client who had previously obtained 2 quickly dispersed fintech loans of less than $30,000 each. The fintech provided no counseling on how to put that money to good use. In fact, he was overpaying himself, resulting in losses each year. He won a Navy contract, but couldn't find a lender because of his losses. And we worked with him to help him understand what lenders look for in reviewing a credit application. And ultimately, we were able to secure for him a $150,000 SBA loan. You see, the community bank model is really quite different. We partner with our small business borrowers and are vested in the long-term growth and success. The reality is that once the loan is funded, that relationship has really only just begun. We provide practical, real-world business counseling and networking opportunities, particularly for startups, in a way that can never be matched by an online-only lender. The best thing for an underserved borrower is to work with a lender that is committed to their success. A small African-American 8A government contractor applied to us for a $150,000 loan. She had recently won a couple contracts, but her low credit score made it impossible for us to approve her loan application at that time. And rather than just turn her away, we worked with her for over a year and a half to increase her credit score, and then celebrated when we were able to give her an SBA loan. I cannot imagine a non-bank fintech lender standing by a loan applicant for a year and a half. We are committed to working with this committee and the SBA to ensure the 7A program is reaching the smallest underserved borrowers, but I also think we should appreciate what the program is already achieving. For example, according to the SBA's own data, 68% of the loans in fiscal year 22 were made to underserved borrowers. This far exceeds the agency's target of 43%. And also in fiscal year 22, 1 in 3 7A loans were to minority-owned businesses. I fully expect non-bank fintech loans to have a higher default rate and a higher incidence of fraud, similar to the results of the Paycheck Protection Program. The cost associated with more defaults and fraud will drive fees higher and make the program more costly and less accessible. We urge this committee to exercise robust oversight on the 7A program with the goal of safeguarding its integrity. Thank you again for this opportunity to share my perspective, and I'm happy to answer any questions you may have.
Thank you very much, Ms. Frazier. Good job. And now recognize the witness, Mr. Flores, for his 5-minute opening remarks.
Chairman Williams, Ranking Member Velasquez, and distinguished members of the committee, thank you for having me today. My name is Manuel Flores, and I am the President and CEO of SummerCore, a certified development company based in Chicago, Illinois, and member of the National Association of Development Companies. I am honored to represent the CDC industry to discuss rule changes affecting the lending programs at the Small Business Administration. CDCs are nonprofit organizations certified by the SBA who meet our economic development mission through the delivery of the SBA's premier economic development program, the 504 Loan Program, as well as the 7A Community Advantage Pilot Program, the Microloan Program, and other federal and state initiatives. My comments today will focus particularly on the affiliation and lending criteria as it relates to the 504 program. The 504 Loan Program is a prime example of a successful public-private partnership with a loan structure that pairs a CDC, which provides up to 40% of the financing for an eligible project through 100% SBA-backed debenture, with a banking partner typically, which provides 50% of the financing, thus requiring only a 10% down payment from the small business borrower. The program finances commercial real estate, including construction costs and equipment, with terms of 10, 20, and 25 years at a fixed below-market interest rate. An important cornerstone and differentiator of the 504 loan program is its economic development mission. To be eligible for a 504 loan, the project must create jobs or meet a public policy or community development goal. The result is a zero-subsidy program that has served more than 175,000 small businesses, provided more than $100 billion in debentures, and leveraged private sector financing for an estimated total investment of more than $250 billion in local economic development, all at no cost to the taxpayers. In addition, the 504 programs have a collective performance of a 0.5% charge-off rate over the last decade. This is in part a result of the multi-step underwriting and approval process that includes loan review by the CDC, a third-party lender, and the SBA. Combine the extensive oversight of CDCs by the SBA with the underwriting and approval process of the 504 program, and it becomes clear why it performs so well. Unfortunately, despite some of the program successes, the 504 program can be weighed down by a complex approval process that can adversely affect the borrower. The CDC lending industry has advocated for regulatory changes to create efficiencies in the approval process for over a decade, including many of the adjustments to affiliation and underwriting included in the recent final rule. Now, NADCO largely supports the intent of these changes, which will provide CDCs the flexibility to be reasonable while continuing to use prudent underwriting practices that focus on insurance repayment ability. As you consider congressional action in response to these rules, I offer the following recommendations. First, there are several lending programs that the SBA impacted by these rules who operate differently, and a one-size-fits-all approach is not the best way to expand small business lending. It is important to continue differentiating the programs and approaching their implementation through this lens. Second, while Congress continues to weigh the rules and their impact, the CDC lending industry and our banking partners need time and open communication with the SBA to understand these changes. Trainings, open dialogue, and a collaborative approach is integral for industry participants to understand and adapt to the rule changes without fear of being penalized. Finally, I would like to also draw attention to a program change initiated by Congress, but for which the SBA has not yet published a final rule. The Economic Aid Act, enacted in 2020, made integral changes to the 504 debt refinance program. It is critical the SBA remove administrative barriers that restrict borrower access to the program and release a final rule as soon as possible. These changes made in the Economic Aid Act are particularly important in the current interest rate environment where the lower fixed rate of the 504 program can provide enormous cost savings to small businesses. The CDC lending industry cares deeply about maintaining a role as a trusted partner for small business success. We will continue to focus on our collaboration and communication with the SBA and Congress to meet our collective goal of making lending programs like the 504 easier, faster, and more secure in support of a strong small business ecosystem nationwide. I appreciate the opportunity to testify this morning, and I look forward to answering any questions.
Thank you very much. Good job. Plagiarism is an evil thing.
I was inspired, Chairman.
Well, thank all of you. Good job. And we will move now to the member questions under the 5-minute rule, and I recognize myself for 5 minutes. Mr. Wilkinson, given your extensive experience with the SBA programs, I wanted to start off by asking you to quickly clarify a few statements that former SBA official Patrick Kelly made at our hearing last week. He said that the changes to the 7A lending program are not terribly new, but would simply put the program in line with the SBA's Express Loan Program. So, Mr. Wilkinson, can you describe why this comparison by the SBA is not accurate?
Well, the SBA Express program has been limited to $350,000 in size. The expansion of doing what you do up to a $5 million loan size is a vastly different approach. And also add that we would have a little bit of a concern about the loss rate that has been seen in the Express portfolio. It's got a 50% guarantee, so you would intuitively think that you'd have a lower loss rate, and that has not been the case. It's running about 2 times the loss rate that the regular 7A program is.
Okay. He also claimed that as part of their oversight of small business lending companies, they give lenders guidance on how they should be compliant with the Bank Secrecy Act and other anti-money laundering laws. So have any of your members received guidance on how to fulfill these requirements from the SBA?
No.
Okay. And finally, Mr. Wilkinson, can you clarify what would need to happen to keep the program operational if loan defaults were to drastically increase?
Well, we are hopeful that this committee will address that through legislation, putting back in the guardrails that have been there for decades to make sure that the underwriting guidelines stay in place and we keep lenders between the lines.
Don't try to fix what's not broken.
Correct.
Thank you for those answers. I also sit on the Financial Services Committee, as several of us do here, and for the last few weeks we've been discussing the recent wave of bank failures. So, Mr. Kasar, can you describe the similarities you see with the fall of Silicon Valley Bank to what the SBA is attempting to do by increasing access to capital to small businesses that might not be ready for prime time, and you've talked about that.
I've seen a lot of term sheets from Silicon Valley Bank over the years, and for the life of me, I don't understand how they make the loans that they do. I don't know other lenders who could match them. So a loose credit culture, I believe, is part of what the problem was, the cultural problem at Silicon Valley Bank. And I'm concerned that a loose credit culture at the SBA will lead us, sadly, to think about SBA and SVB in the same sentence in a couple of years if we completely loosen so many of the guardrails.
All right. Now, yesterday, the ranking member and I sent a letter along with Chairman Cardin and Ranking Member Ernst in the Senate to the SBA, asking for them to pause on attempting or implementing these rules until a full-time head of the Office of Capital Access is installed. Ms. Frazier, you touched on that, but do you think this would be a good idea given the unexpected departure of the former Associated Administrator who sat in that seat last week? And can you describe outstanding questions you still have about the new rules?
Thank you. Well, given that the new rules were rushed and just recently put out, many of us as lenders are still trying to absorb what is in them and how would they be affected. So the pause, not only a pause would be necessary, but I think also gathering existing lenders together that have experience with the current SBA rules and reflect upon what could be changed to make it simpler, but maintain prudent lending standards. And I would also recommend not only the pause, but should the changes any changes go into effect, give it time for the current lenders to process and absorb them and see the impact before we allow any more small business lending companies into the program.
Thank you very much. I now recognize the ranking member for 5 minutes of questions. Ms. Velasquez?
Yes. Mr. Flores, as your testimony demonstrates, it is important to differentiate the 504 and the 7(a) loan programs, which are both impacted by the rules we are discussing today. And you yourself stated that in your opening statement. The 504 loan program is an economic development program with job creation goals. Can you walk us through the 504 underwriting process and why you believe the changes in the affiliation rule will benefit 504 loan borrowers?
So, Ranking Member Velasquez, thank you for your question. The 504 loan underwriting process is unique because it includes 3 different parties and multi-layers of underwriting and examination, all with the goal of ensuring borrower solvency. So you have the certified development company with staff who has expertise in underwriting, also governed by policies and procedures, risk weighting and concentration tracking, all of which have to meet SBA requirements, which also includes independent loan review by a loan committee, as well as the board. In addition to the CDC, you have a lending partner, typically a bank, that will also have to follow its own loan procedures, sound safety and soundness, prudent lending. I need not remind this committee here that banks are also regulated by banking regulators. I was a former banking regulator, state chartered institutions. And then you also have the SBA that also reviews the loans for the purposes of, again, underwriting and then also eligibility requirements.
I have a lot of questions, so please
So
be brief.
it's a very thorough process,
Okay.
Ranking
Thank
Member.
you. So as lender, borrowers, and even us here in Congress try to get up to speed on the details of these 2 rules and the SOP, I understand mistake will be made. What has your interaction with the SBA been like? Have they tried to explain the details of the rules to your organization in order to help you comply?
So a lot of the changes that we're seeing, frankly, have come from years of communication with the SBA in engagement with the CDC industry. Just as recently as last week, we had a number of meetings with the SBA leadership and other members to reflect upon some of the changes. That being said, I do believe, Ranking Member Velasquez, that it's prudent that the SBA continue to gauge the industry. I agree with the notion of openness, transparency, and collaboration in making sure that all the stakeholders understand the changes so that we can do our jobs in helping small businesses access these amazing
Thank you.
programs.
Thank you. Mr. Wilkinson, I am sure you are aware I have been advocating to do more small dollar loans, those from 50 to 150,000. And there has been a decline, about 50% decline in those type of loans. So my question is, what will you do to have, why is it that lenders are not making these loans?
Well, I think from where we sit, 50% of our loan approvals by number of loans are $150,000 less. So those are small dollar loans. In any given year, based on economics or lender business models, those numbers change. They fluctuate. And if you go back 5 years, we had a couple of major SBA Express lenders exit the program. So you saw a decline in the small dollar loans at that point in time. But if you go look today, you'll see our small dollar loans are coming back up. I think the fee waivers are playing an important role.
We have issues with the data, right, that is coming to us from SBA itself. So, what would you say to those that say that this is simply about market competition? How do you respond to that?
Couldn't be further from the truth. Banks can enter this program today, leave tomorrow. We get banks entering all the time.
In terms of myself as ranking of this committee and as chair of this committee, for 30 years now, I've been advocating for the smaller of the small businesses and for those small loan from 50 to 150,000. The truth of the matter is that there is a decline. So I want to make this effort a reality to get loans to underserved businesses who need it the most. And my question is, how can we achieve this goal using the rules as a framework?
Well, first of all, I was starting down the path of the fee waivers are working right now. You're seeing an uptick in small dollar loans. You're seeing an increase in 150,000 and under. We're running ahead of last year's pace by, we're 25% ahead of last year's pace on loans of 150,000 and under. So we're making progress. We could expand the microloan lender network because they're specifically focused on loans of 50,000 and under, and they add the technical assistance component. And then perhaps if we gave lenders some credit in their Paris reviews, if they did a specific percentage of loans under 150,000.
Thank you. I yield back.
Thank you very much. Next, I'd now recognize Mr. Lukemeyer from the great state of Missouri for 5 minutes.
Thank you, Mr. Chairman. Welcome to the panelists. Mr. Wilkinson, I'd like to start with you this morning. I've got in front of me this morning a copy of the Federal Register, which publishes rules and regulations that are promulgated by different agencies. This particular page, the particular pages I have in front of me are with regards to Small Business Administration, and they say and I quote, SBLCs are non-depository lending institutions authorized by SBA only to make loans pursuant to Section 7A of the Small Business Act and loans to intermediaries in SBA's microloan program, which says only those kind of loans. But then it says later on that SBA agrees with the previous paragraph, which mentions that they're going to do away with that. And it says, we'll revise the paragraph by removing the word only to make it clear that SBLCs and community advantage SBLCs may participate in other lines of business initiate in addition to 7A lending or making loans to intermediaries. Mr. Wilkinson, what's the impact of that?
Well, I have huge concerns about that because this change, as you note, there is now nothing in the regulation to prohibit an SBLC from making other types of loans or engaging in other business products. More importantly, this change significantly would add to SBA's oversight burden, since when it is evaluating institutional safety and soundness, they now have to be up to speed on all the other related lines. And I think
what's the mission of an SBLC?
Mission of an SBLC? Well, currently the SBLCs are standalone, separate corporations that only do 7A loans.
Okay, so what they're going to do is they're going to make these mini banks. Is that what we're going to be? Is that a way to? That's another way to frame it.
That's another way to frame it.
So, Ms. Frazier, you're a banker. You like this competition? Having the SBA be the new bank lender in your community for small businesses when they're supposed to be the lender of last resort, now they're your main competition. How do you think about that?
I don't think very highly of it, quite frankly. As I've testified before, when the direct lending was an option or being proposed from that perspective, is that what you miss and what many of us are saying here is the relationship and the coaching and the counseling many of these borrowers need in this process, and they need the education towards their financials. And to create an online process that's scored and the decision is made against a few metrics or factors, you don't achieve what I believe is what everyone desires, is a successful entrepreneurship in business. So I'm not excited about that kind of competition, only because I think it diminishes really what the SBA is trying to achieve.
Well, it would seem to me that what would happen is you'll turn somebody down because they're not credit worthy or they've got a problem, and they're going to run across to an SBLC who now has no criteria. Last week we talked about this with Mr. Kelly, and they don't have know your customer stuff. We don't have all these other things in place that during the PPP program really differentiated between the banks and the fintechs in how they were able to get the funds out the door and be able to do this. We found that the fintechs were basically the problem children with the PPP program, with the way that they did not do the oversight that they really need to do with regards to their customers. So it looks to me like we've got a real problem with direct lending here, especially whenever the SBA, with their EIDL program, was fraught with fraud. And so now we're going to make them a direct lender in multiple areas.
Right. Not a good thing, because the relationship isn't long-standing. It's package up a portfolio, sell it, service it, and you miss the opportunity to really develop business and help with economic success.
Mr. Kasar, would you like to elaborate a little bit? I think you said a minute ago something about loose credit culture. This, to me, is our whole problem, is that SBA does not know how to do direct lending. It's proven by the programs that they have, the losses they sustained. They don't do their due diligence on underwriting. And now suddenly they want to expand those programs, be in direct competition with the banks who we already know do it right. And so now it looks to me like we're going to wind up putting a big burden on the taxpayers to underwrite this whole situation. Would you like to comment on that?
Absolutely. And in addition to the prior point you're making, if these new SBLCs can do any other kinds of loans, if for whatever reason a borrower does not qualify for an SBA loan, they can quickly move them over to a high interest, very expensive loan that many, not all, but many of these fintechs are doing. That creates a high-speed debt treadmill, which is a dangerous
one more quick question: where are the SBLCs going to get their funds to loan? If they're going to expand their loan program, where do they get the money for that?
They might get them from private lines from banks.
I yield back. Thank you.
Next, I now recognize Mr. McGarvey from the great state of Kentucky for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here today and talking about this incredibly important issue. Last Congress, after an extensive investigation into the Paycheck Protection Program, the House's subcommittee on the coronavirus crisis found that fintech and other non-depository institutions failed to establish systems that would stop obvious and preventable fraud and profited off processing fees for each loan they completed, leaving little incentive to find the fraud. The subcommittee issued a report in December recommending that, quote, any plans by SBA to again open 7A to fintechs and other unregulated non-depository institutions must be accompanied by a well-defined, more rigorous, and better resourced initial review process, and that such entities should be subject to continuous monitoring to confirm their adherence to SBA rules. Mr. Wilkinson, you talked a little bit about this in your opening statement, and just want to go a little bit more in depth with you on it. Do you feel that the rule changes proposed by the SBA are just that, well-defined, more rigorous, and provide a better resourced initial review process?
No, they're not. They're devoid of any guardrails. SBA lacks the capacity to be the prudential regulator for the new SBLCs. So, no, I disagree that they've done a good job here.
What do you think should be happening?
Well, I mean, there's a whole long list. First of all, many of the guardrails should remain in place. I would tell you that when the FinTech group came to lobby us, they asked for higher interest rates. They asked for the ability to charge higher fees. They got that. It's in the new SOP. They asked for the ability, and I'm sorry, Mr. Lukemeyer just left. They asked for the ability to sell 100% of the loan, not just the guaranteed piece. So there's a program underway at SBA to allow fintechs to sell a significant portion of the loan. That's where they're going to get their funding. And they asked for us to help them get rid of the credit elsewhere test. And at that point in time, we knew we were not going to be on the same page with these folks. So the fintech group that's trying to get in right now has a vastly different idea of what this program should look like than we do.
And tell me, what's the practical effect of that to people looking for SBA loans?
Well, I suspect that there will be more folks that will get the loans, many of whom probably shouldn't. It's going to be down to an algorithm that's done online. And the practical effect for us sitting in this room is you're going to see significant increases in loss rates, which is going to put an upward pressure on the cost of the program. And we'll all be right back in here talking about how are we going to raise fees on borrowers and lenders, or are we going to be able to come up with an appropriation, with the discussion being, you're doing riskier lending, why should you guys appropriate money? And that's going to be a hard one to defend. But rest assured, losses are going to significantly increase with these rule changes.
I appreciate your input and insight into that. And obviously, one of the things I'm concerned about, you've heard Ranking Member Velasquez talk about this, is making sure that people who need these loans, particularly the smallest of the small businesses, the people who are underserved, the people who have not had access to capital, get that type of access to capital. It's clear that fraud was an issue with the fintechs. So we've established that. I don't think you're seeing a debate in that committee. But we also know that they did reach more women and minorities than traditional lenders did. So, Mr. Flores, what changes do you think are out there that you would propose to current rules to allow for lenders to serve more diverse and underserved populations while also protecting borrowers?
You know, that's what makes the Certified Development Company Network very unique, is that we are about economic development. So our charge is to make sure that not only are we informing and educating the public about small business lending, but in particular also providing technical assistance in partnership with other organizations. And our mission is to make sure that we not only promote the SBA lending programs, but that we do it in a way where the borrower is able to actually derive the full benefit of that loan. So a lot of work goes into engagement and communication. And it's done in partnership with the Small Business Administration and individual CDCs, other economic development organizations. I would hearken back to the comments that I made as a former banking regulator as well, is that the Small Business Administration working with the industry is critical in making sure that we are able to track the performance of these programs objectively, and also to not lose sight that in the end of the day, while we may have deep concerns about whether or not the new guidelines may impact certain types of loans, that we not forget about the gap that exists with regards to access to capital for minority-owned businesses and rural-based enterprises. We have small businesses that need this access to capital, and I think we can balance both prudence with increased access to groups that have been historically left behind in terms of access to capital.
Thank you very much. I'd love to ask more questions. Appreciate the conversation that we're having here today, but I'm out of time. So, Mr. Chairman, I yield back.
Very much. Now I recognize Ms. Van Dyne from the great state of Texas for 5 minutes.
Thank you very much, Mr. Chairman, and thank you for holding this important hearing, highlighting how this proposed rule change will be detrimental to small businesses across the country and will lead to an increased risk to the American taxpayer. Just 4 weeks ago, we had the SBA Inspector General in this room where he shared the same concern we're hearing today. It's clear that the SBA is in no position to take on additional responsibilities. From allowing fraud to run rampant in pandemic relief programs to this unprecedented weakening of lending standards in the SA and the 7A lending program, I am deeply worried by the Small Business Administration's pattern of incompetence and seemingly disdain for taxpayers. One major concern with this rule is the change to credit available elsewhere, which requires that a lender look elsewhere for credit before looking at the SBA for funding. As for this proposed rule, SBA eliminated the requirement of providing the reason and instead moving towards a loan volume over loan quality. So, Mr. Wilkinson, I appreciate you being here, and I appreciate the testimony that you've provided so far and your answers to a number of questions. But I'm the co-chair of the Congressional Franchise Caucus. And I'm particularly concerned by the impact of this rule on our franchise small businesses, which are a vital part of our economy, especially in North Texas. Seeing as the SBA is going to stop publicizing the franchising directory that allowed lenders to quickly reference whether an entity qualifies for an SBA loan, are you concerned that this will make lenders more hesitant to lend to franchisees?
It absolutely will. And you are correct, the franchise registry has been pulled down from the SBA website. We instructed our lenders to download the latest and greatest list of approved documents the day before they pulled it down, so lenders could still go back to that registry to see who would still be eligible. But correct, there's going to be a lot of lenders who are going to be very hesitant based on the new rules to engage in franchise financing.
I appreciate that. In the recently issued SOP, which takes effect on August 1st, SBA revised the requirements regarding what a lender has to do to prove that the loan complies with the statute requires, which says a borrower can't get a 7A loan if they can obtain credit elsewhere. Mr. Wilkinson, what did SBA change about credit elsewhere, and why do we need to know about these changes? What do we need to know about these changes?
Two important changes. First of all, every time you make an SBA loan today, you have to have a narrative in the credit file as to specifically why that borrower cannot obtain credit elsewhere. It's got to be detailed out. The rule change has been made, in my opinion, to benefit the fintech group who wants a computer-driven algorithm, low-touch program. So they've made this a check-the-box exercise. So all you have to do is, as the lender, check a box, and it's done. Secondly, they have changed the personal resources test. Beforehand, if a borrower had significant personal wealth, that would be a source of funds that we would say had to be tapped first before borrowing on an SBA loan. That has been changed, so personal wealth is no longer an issue. So, yeah, rich people can get 7A loans.
I appreciate you saying that. Mr. Kasar, you had mentioned earlier that not everybody who applies for a loan needs a loan. If we are going to turn to basically just checking a box now, do you think that the SBA or that these fintech lenders are going to be able to provide the same type of quality of service that you can by walking through everybody who applies for a loan, whether or not they need it, the level that they need it, and whether they can pay it back?
Absolutely not. You have to remember that SBA lending, it's a work of passion. It's often more art than science. So it's underserved or served borrowers or across the spectrum. First thing you have to really ask them and understand is, what's this money for? What do you want to do it? What's your plan? How are you going to make more money? How do you propose to make more money with this loan than it's going to cost you to service?
So you're saying you don't treat everybody the same?
I'm not saying you don't treat everyone the same. What I'm saying is that you have to have a thoughtful conversation with a borrower to begin to understand what's the root of their ask. Do they have a good reason for not needing this money? And if they don't, you have to counsel them to take some time and do some planning and some thinking and then come back to the table when they're ready.
So you think that the personalized service is of a greater value than just checking a box and going?
100,000%.
Do you think that actually helps people not have to borrow beyond their means?
100,000%.
Do you think that actually helps them to be better small business owners?
100,000%. If you borrow too much money too quickly or without a plan, you get into trouble.
And do you think that the SBA is actually providing that with this change in service?
Absolutely not. They're trying to streamline it, make it quick, fast, and automated.
I appreciate that. I have one quick question. During my oversight hearing with IG Ware, Mr. Ware shared his concerns with self-certification, and now the SBA is moving forward with self-certification for the credit elsewhere test. Mr. Wilkinson, how do you think this will affect lender behavior?
Well, it's going to make it much easier for fraud to enter the program. I think we're instructing our lenders to, when SBA says do what you do, we're telling them do what you should do, because there's going to be a point in time in the future.
Time is up.
All right. Thank you very much. I yield back.
I now recognize Ms. Glusen-Count Perez from the great state of Washington for 5 minutes.
Thank you, Mr. Chair. Mr. Flores, thank you for being with us today. I know this is a hearing nominally on the 7A program, but I want to first address the 504 lending program. So before I came to Congress, I actually own a small business and got a 504 loan. It took me a year to do it. It's about the size of a phone book. I know you share my goal of creating efficiencies in the 504 program to streamline the process for small business owners. The affiliation rules changes the underwriting criteria for both the 7A and the 504. So am I correct to say that there are multiple layers of underwriting and examination in the 504 program?
So, Congressman, if you recall from the process, you were dealing with a certified development company, a third-party lender, and also the SBA. The SBA actually had to review all the work that was done and then ultimately decide whether or not it was a worthy loan. So there are multi-layers just by virtue of the structure of the program, which is very unique. And again, I want to reinforce, it differentiates the 504. It's a differentiator between the 7A. But beyond that, as you recall, and I do want to reference, you referred to just the process, that there are certain complexities built in that we believe that with some of these changes, it will make it easier for that borrower to access this amazing program with, again, compromising any level of integrity or oversight over the loan program. Again, we want to make prudent loans. It's in everyone's best interest to make sure that the 504 loan program continues to succeed as it has, and to provide greater access to capital for small businesses.
So how exactly do the affiliation rule reforms fit into the multiple layers of the 504 program approval process and streamline it for small businesses?
So, a couple of things. So I referenced one particular story where you had relatives who were given the opportunity to own a couple of the restaurants. Actually, the father started. Ultimately, then, a couple of the siblings wanted to move forward with a particular project, and the third sibling did not want to share particular financials that were required under the SOP. And it ultimately led to a particular situation where the project couldn't go forward because one of the siblings who was not involved in this other new venture, wanted to put forth financials. Ultimately, the family got together and cooperated. But again, that was a situation where you had this very unique, complex process that didn't really apply to that particular situation, almost deprived that family from being able to access the 504 loan. With regards to franchises, again, one of the challenges that a lot of franchisees have to manage is getting, demonstrating that the franchise is not going to have some level of ownership in the particular business going forward. So now where you have that removal, and there's no issue with regards to control now, it makes it easier for that small business to move forward if it's a franchisee. So the whole notion here is to make sure that we are providing guardrails, but guardrails that apply to what is really happening with regards to the small business needing the capital for their particular business need in moving forward. Again, I would say that the process in place with a CDC working in partnership with a third-party lender and the SBA, you have layers of oversight to protect the integrity of the program.
Thank you. Mr. Wilkinson, it's good to see you again. Could you speak to how the 7A program structures differ from the 504 program?
So our structure is a guarantee program. So the lender makes the loan with a percentage of that loan guaranteed by the SBA, but the lender actually funds the entire loan.
So is it safe to say that the reforms that benefit one SBA program may not work for another SBA program?
They may not.
Yeah, and thank you for that insight. I agree that we should not be painting these with a overly broad brush. And this last minute, I would love to hear some insight on what we could do to streamline the 504 and make sure that those dollars are getting to small business owners that need it. Ms. Frazier, if you have thoughts on that.
Thank you. I think the reference to the phone book is quite adequate, and I think it's overwhelming at times from borrowers who are maybe not as sophisticated and have borrowed money for commercial real estate in their property before. So I think anything we can do to help streamline but not lose prudent underwriting standards in the process would be helpful as well, and even the documentation. Getting that down to something that folks can absorb and understand, and it's simplified, and I think those types of things would be very helpful from the process.
Thank you. Mr. Chair, I yield back.
I now recognize Mr. Bean from Florida, the great state of Florida, for 5 minutes.
Thank you very much, Mr. Chairman. Good morning to you. Good morning, Small Business Committee. Good morning, panelists. We're glad to have you here. I've only been here 22 weeks. I'm a new guy, 22 weeks, and I have discovered that this place is crazy town. It's crazy town because only in crazy town can a government agency come and have an abysmal record of losing taxpayer money, and then come and say, hey, we want more money and we want to ease the standards of giving it away more frequently. Yesterday in Crazy Town, I was on a committee and spent 4 hours listening why it's a great thing that we would give away taxpayer monies in the form of student loans. Why that's a great thing. And then even finding out, this was in Crazy Town, a big sizable part of those student loans didn't even go for tuition. They went for trips and cars and stereos. How about that? But that's what happens in Crazy Town. So, and as a former banker, I know there's some bankers up there. It's just unfathomable that that we would ever forgive a loan after the person agreed. This is the terms of the agreement without even trying back. So it's a toss-up for the panelists. Are we in Crazy Town? Who wants to answer that question? Are we in Crazy Town? Is this Crazy Town?
I'd love to take that question on.
Jump in, my friend. Welcome to Crazy Town.
Well, thank you for that question. I would tell you that over the last several decades that I've been involved with this program, we have taken steps, as we have seen lender behavior and borrower behavior as well, to put guardrails in place at SBA to make sure that this program operates on a sound basis. We view this as a three-legged stool with the lenders, the borrowers, and the federal government representing the taxpayer. We need it to work for all three of us. And so I would say over the last, especially the last 2 decades, you can go look at our performance, and it's been really, really good. In the last probably 5 fiscal years, our charge-off rate's been running under 0.5%. I think it's a very well-managed program. It's working for the taxpayer, it's working for the borrower, and it's working for the lender. So I think in this particular case, the 7A program, as the chairman said, it's not broken. It's working just fine.
So to make these moves, we would be going to Crazy Town. Is that your testimony today before we're going to Crazy Town making these changes?
I believe these changes will lead to significantly higher losses in the 7A program.
Very good. Mr. Kasar, you've been sitting there. I want you to jump in. I want you to jump in because it used to matter. Criteria used to matter, and I made loans myself at a small bank in Northeast Florida, and it used to matter, could the customer pay us back? That was the number one question my boss and my committee, can they pay us back? That was important. I had to answer that. But it seems the SBA is less concerned about getting paid back. But is that what they do in Crazy Town? Mr. Kasar, welcome.
Thanks for having me. Listen, one of the things I've loved about SBA lending, being involved in it for the last almost decade and a half, is that it hasn't felt like Crazy Town until now. So to the point of Tony, we've had a balancing act, and it's worked for all the parties involved, and it's helped tens of thousands or hundreds of thousands of business owners and entrepreneurs. But it feels like Crazy Town to me when you say, we're going to throw it all up, we're going to change it all up, all at once. That feels like Crazy Town to me.
And then you got to add this to the mix. After their horrible report card, and it's just, they do it with a smile and say, okay, we've done such a horrible job. Give us more and let us ease the standards so we can get more taxpayer-funded programs out the door. And then, like I said in the committee yesterday, let's just forgive all debt. But that's what they do in Crazy Town.
I think it's super important to note, though, that conventional SBA 7A lending that's been around for decades is not the EIDL program or not the PPP or not the Restaurant Revitalization Fund. And you start to get a little Crazy Town when you compare them because you're comparing like dramatically different programs, and you have to be really careful to separate those guardrails.
Gotcha. Typically, Miss Alice, it would matter if the borrower could pay us back, but we're in Crazy Town, so should it matter that the borrower could pay us back, Miss Alice?
It should always matter. And one of the things that you know as a former banker, that you're looking for some skin in the game from the borrower as well. And that's part of the new rules, is there's no necessary reason to show any skin in the game from that perspective, and that's part of paying it back from that perspective. I would also say to become a preferred lender, you have to prove yourself trustworthy and to be trusted with what the government is allowing you to do on their behalf. And in that point, we all take that very pridefully. And to remove these rules, it's not the same anymore.
Amen. Ladies and gentlemen, thank you all so much for coming forward, and welcome to Crazy Town. Mr. Chairman, I yield back.
The gentleman yields back. I now recognize Ms. Sculton from Michigan for 5 minutes.
Thank you so much, Mr. Chair, and thank you to all of our witnesses for coming today. We truly appreciate your testimony. I said this last week to Mr. Kelly, but of course it bears repeating today, that these rules are nuanced. And now that the SBA has finalized them, it's up to Congress to do the necessary oversight of the SBA to make sure that they're implemented correctly. And we do have concerns, as you've heard today. So my first question is for Mr. Frazier. In your testimony, you state that the best thing for an underserved borrower is to work with a lender that is committed to their success. I completely agree. I've seen this firsthand. I've heard from financial institutions in my district about their concerns regarding fintechs that may become authorized SBA lenders under this new finalized rule, one of the top concerns I've heard about. What services does your bank offer underserved borrowers that a fintech cannot? And what guardrails do you think the SBA should have in place to ensure predatory lenders are not allowed to participate in the SBA program?
For our bank, I'll speak for us, is we are involved with a number of initiatives locally. There's through chambers, there are typically some programs focused on women and minority borrowers to help educate them. We also work closely with the NAACP organizations, et cetera. And then we also have education programs that we hold for our local clients and the prospects. But I don't think that I'm unique in that. I believe most of our community banks across the nation do the same thing because we're committed to the communities we serve overall. And I'm concerned, and from the fintech perspective, it's not about what you're doing to actually help the economics and help the businesses grow and help them use the money appropriately and to get the right size loan that's appropriate, that they don't go too far into debt. And in that situation, this is where the banker becomes more of a partner to them than necessarily just a place to get money. And that partnership lasts for a long time and can serve all very well.
Okay, thank you. Apologize for saying Mr. at the outset. And maybe you didn't hear me. Okay, good. You let it roll.
I just let that slide.
Good for you. I get called Mr. all the time, actually. I don't mind. So I have a second question. Another concern that I've heard from financial institutions in my district is changes to the underwriting criteria the SBA is making in the affiliation rule. This is also a topic that Mr. Kelly discussed at length last week. Ms. Flores, I'm kidding, Mr. Flores, my question is for you. In your testimony, you expressed support for the intent behind the SBA's changes to the underwriting standards. From your perspective, how significantly do you think the underwriting standards will change because of the affiliation rule? How will these changes to underwriting criteria impact the level of consistency in loan evaluating and processing?
Thank you. So from our perspective, we are going to continue to use our prudent lending practices. We have guidelines, we have policies and procedures that we have to vet from our own internal loan committee board of directors, as well as the SBA. We are still going to be using the 5 C's of credit: capacity, capital, collateral, conditions, character. And frankly, even there's been discussions of moving from 9 to 3 various credit factors. But if you take a look at the actual SOP, the language of the SOP, and I quote, "Lenders and CDCs must use appropriate and prudent, generally acceptable commercial credit analysis processes and procedures consistent with those used for their similarly sized non-SBA guaranteed commercial loans. Lenders, CDCs, and SBAs may use a business credit scoring model." When we read that, we're looking at, okay, well, also our banking partner has to make sure that they're following their rules and procedures. They can't run afoul of those procedures because they'll get in trouble with their banking regulator. The SBA itself, Okram, we're going to be measured and gauged by whether or not we're following our own policies and procedures, and if we're also being prudent in our lending. Now, the streamlining here is to, in my opinion, and the opinion of many in the CDC, industry here, is how do we make it easier, though, and less burdensome on that small business borrower so that they don't have to come in with a telephone book, as it was just described earlier, and where, frankly, it doesn't have to take a whole year. Think about what happens in the real world. You have small businesses who want to make investments. And sometimes, and in the end of the day, time is money, and time is opportunity. But here with the 504 program, it's not just about what's in the best interest for that small business. It's also about the impact that we have in creating more jobs, bringing more local investment. So it's in everyone's best interest to make sure that that 504 loan program gets in the hand of that small business borrower in a shorter time frame, responsibly, and then the benefit here is you're also seeing more investment in our communities and greater access to minority-owned businesses and rural-based enterprises.
Thank you. I appreciate that testimony. Yield back the remainder of my time. Thank you.
The gentlewoman yields back. I now recognize myself for 5 minutes. Thank you all again for being here. Chairman Williams mentioned the letter earlier that was just sent, I believe, in the last couple of days, also signed by Ranking Member Velasquez and the Ranking Member and Chairman from the Senate to the SBA, stating that this program needs to be delayed due to the lead person on it, Patrick Kelly, no longer being with the SBA. We're all sitting here stating, and your concern is that potentially unworthy businesses will be receiving loans and will increase your subsidy rate for the program, and among other things, obviously. And so clearly this is a bipartisan understanding that they're moving forward in real serious haste, which could have real serious ramifications on taxpayers as well as yourselves. Is there anything about this that you find reasonable? Is there anything about this initiative that could work for you, that you think actually is can be a positive thing? Anything at all? I'm going to ask you, Ms. Frazier.
Well, certainly. Thank you for that question. But certainly there are pieces in there that could help smooth the process, make it easier to get credit there. But I think taken as a whole, it is too much risk.
Okay.
And so it needs to be dissected. You need to I really recommend, as part of the ICBA, bring lenders in and dissect it and pick the best parts so that we remain prudent, that we keep safe the monies that are put out there and do the right things for the borrowers.
Good. Absolutely. And I'm absolutely favorable to that, and that's exactly how we should proceed. Mr. Kasar, good to see you. Thanks for making the trip down from Pennsylvania. I make that route quite a bit myself. You stated that the SBA is focused on a misguided solution in your testimony to broadening access to capital while burdening future generations of taxpayers with the fallout. Seem to have some existential concerns about the 7A program due to this initiative. Could you expand on that?
Sure. Again, I think there are many elements that could be terrific. I think there should be some role for fintech. It's very careful to put fintech in one category. Fintech is a broad industry with different players with different philosophies. Better use of technology in the program at different stages is good. What's dangerous here is doing it all at once.
Yeah.
And because I don't know if the SBA has produced any forecasts about what will happen to default rates as a result of these changes. And if they have one, I don't know how they did it. So if we say, we're going to try this for this quarter, and then we'll be able to measure it, and then we'll add this element next quarter and this element next quarter, you will start to see and understand what's working or not. To say that the SBA program shouldn't evolve and innovate and change or leverage technology, I think is irresponsible. But to do it all at once, like a big crazy science experiment, I think creates a lot of risk.
And as business people and entrepreneurs, I can understand that you all would have that sentiment. Mr. Wilkinson, let me ask you this. The 7A loan program statistics look like for smaller dollar loans and underserved market loans, The SBA states that the 7A loan program does not succeed in underserved market lending. You want to comment on that? How is the 7A program working as effectively as it should be right now?
Well, we can always do more, but we've got just over 50% of our loans and loans under 150,000. And with SBA's new definition of small dollar loans being at 500,000, about 3/4 of our units. I mean, that's a significant portion of our portfolio are in small dollar loans. We also have to keep in mind that it is the larger transactions that pay the cost for the smaller ones. And so we got to have a pretty good mix of both.
Okay. And last week, the former Associate Administrator Patrick Kelly told this committee that all of the concerns amounts to a lot of fuss that has been made about banks being upset about 3 fintech companies being included in the program. What do you have to say about that comment?
Well, we welcome in lenders to this program all the time. We would be happy to have quality lenders who are well capitalized, who understand the rules and regulations of the SBA program, and who are appropriately regulated.
Sure.
What we don't want is lenders who don't know what they're doing, that aren't appropriately regulated, abusing the program. But I would echo Mr. Kasar's comments about fintechs. We have a number of fintechs that work with our lenders today. We have a fintech who is a lender. They went out and they bought a bank. They're capitalized, they're regulated by the OCC, and they're a good corporate partner.
Thank you. Mr. Flores, I want to ask you something quick. In your testimony, described the 504 program as a successful public-private partnership. What did you mean by that? And you get 1 second to elaborate.
Banks, private lenders, CDCs, SBA, with the support of Congress, that's a winning calculation.
All right. Thank you very much. I yield back. Now recognize Ms. Chu from California for 5 minutes.
Mr. Flores, I want to make it clear that I share many of the concerns raised today, particularly around unregulated entities being able to make loans when there's still questions regarding fraud and PPP. But I also want to ensure that our response to these rules is nuanced and recognizes the positive impact these rules will have on lending in underserved communities. For example, you testified that the affiliation and lending criteria rule implements some welcome changes to the 504 Community Development Program. And in fact, CDCs had specifically asked for these changes to be applied to the 504 program after they were first applied in April last year to Community Advantage lenders. As a CDC that makes both 504 and Community Advantage loans, can you discuss how the changes to the affiliation and lending criteria will help lenders like you better fulfill your mission of reaching underserved businesses? And in fact, you have an example in your testimony about a specialty food brand that you had loaned to for their property, and then 10 years later, they sought additional financing, but they had grown and had 40 affiliates, and the burden of providing documentation on 40 different affiliates, many with no direct ties to the business seeking financing, was too arduous to close a loan. So how would it be different, with these rules?
What it does is it loosens up, again, not loosens, it makes it easier in a more streamlined, efficient way for us to determine whether or not the borrower is meeting the spirit of being able to access the 504 loan program, knowing that we are providing some very favorable terms to that borrower to provide that access to capital, to create jobs, to make local investments. In the particular story that you just referenced, it was sad to see here a very successful business operator who had a dream. We provided an SBA 504 loan. That individual continued to grow their business, made other unrelated investments, but because of those older rules, was asked about all of these other unrelated, essentially entrepreneurial endeavors, and then now the individual said, I just simply have no time to comply with all these requests. I'm walking away. I do not have time in order to be able to then make this additional investment. And that was a real lost opportunity. I just want to reinforce again that we're talking about, that's why it's important to differentiate between the 7A and the 504 loan program. And I want to make that clear here. And that differentiation is important so that if we're thinking through of how to apply the rules, we have to look at it from the perspective of the difference between the two programs. Again, I want to also reinforce just the customer service experience and how critical that is. If you have customers who don't have faith in the program, they're not going to come to the SBA for the 504 loan. They're going to say, hey, I'm going to look for a more expensive, more a different option because it's easier. You know, and what does that mean? It also has a negative effect, frankly, on our lending partners. If our lending partners or the bankers or other private lenders believe that it's too onerous to do a 504 loan, they're not going to help us promote the 504 loan. They're going to say to their borrower, hey, you should do something else because it's going to be easier and faster for you. And that happens.
Mr. Flores, your testimony also urges sufficient time and communication from SBA so that lenders could understand and implement all the changes to the two rules. As we know, since the final rules came out in April, the SBA has released a number of agency notices laying out various lender and program requirements in a piecemeal fashion. There have been a lot of twists and turns in this, and then last week the SBA released a 400-plus page SOP, which lenders have to review and comply with by August 1st, so that takes only 2 months away. So do SBA lenders, particularly smaller mission-based lenders like CDCs, which may have fewer resources to navigate various program changes, do they need more time from SBA to implement these new rules? And what specific additional resources do you need from SBA as you seek to become compliant with these new rules?
So as a former regulator, when I dealt with banks and other financial services institutions that were impacted by changes that we were making as an agency, engagement with the industry was always part of the process. I do give the SBA some positive marks in terms of some of the already engagement that they've undertaken with us. However, I do think that we still need to continue this open dialogue. I think we need to continue to have actual meetings, technical assistance, and providing that a reasonable onboarding ramp, and not just for certified development companies, but also for our lending partners.
Thank you. I yield back.
The gentlelady yields back. I now recognize Mr. Alford from Missouri for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Velasquez, for holding this important hearing today, and thank you to our witnesses for coming in today. Really appreciate it. One of this committee's core functions is to conduct oversight of the Small Business Administration. I'm glad to be here today with my colleagues to continue that and discuss the Biden-Harris administration, SBA's disastrous rules that really compromise the soundness of the 7A program and puts taxpayers and small businesses at risk. Like many of my colleagues, I'm worried that the SBA is not able to effectively regulate this space and this activity. As a previous small business owner, I know how important capital is to small business, and I also understand access to capital can be a challenge, especially in districts like mine, which really has banking deserts. So let me be clear, I'm not anti-fintech, but I am against the rules that decrease standards and increase risks, threatening the integrity of the current system and leaving taxpayers on the hook when something goes wrong. The SBA released procedural notices about these rules the night before last week's hearing, the night before, leaving us zero time to review them. I'm here to tell you today, Americans deserve better than that. They deserve better than the fly-by-night Biden-Harris SBA, which is why I'm pleased to learn of the departure of the SBA official chiefly responsible for these rules who was with us last week. Mr. Kelly's blatant disrespect to this committee and its members last week showed a disregard for Congress, and it showed a disregard for small business owners. It also underscores the importance of congressional oversight so an unelected bureaucrat cannot shamelessly advance an agenda. Now, with no one at the helm of the SBA's Office of Capital Access, adding to the vacancy the offices already have, which are many, the Biden-Harris administration must put a pause on these rules and do it today. Mr. Wilkinson, if you Google federal financial regulators, the SBA does not show up, nor does the SBA show up in a March 2020 Congressional Research Service report titled Who Regulates Whom? An Overview of the U.S. Financial Regulatory Framework. The SBA is not a financial regulator. But if a fintech only participates in the 7A lending program, you'll be the sole federal regulator. Fintechs facilitated so much PPP fraud as well. Mr. Wilkinson, given your experience and perspective with 7A, should this committee and taxpayers trust the SBA as the sole federal regulator of fintechs in this program? Why or why not?
At this point in time, no. I'm a fan of the job, the effort the folks in the Office of Credit Risk Management at SBA are doing, but they are understaffed. They are under-resourced. They're 40% understaffed right now. They've got so many vacancies. it'll be hard for them to catch up. I think that the will is there to be a regulator, but they are not given the resources to do so. But they also don't have the framework to be the prudential regulator like an OCC or an FDIC. SBA is really good at looking at transactional risk, looking at the loan, but they're not looking at the capitalization and the interest rate risk and the other risk buckets that would be looked at by a prudential regulator.
Mr. Wilkinson, we've been told that this is a Biden-Harris administration effort, but Joe Biden said he wants to increase regulations for banks, while at the same time this rule removes most underwriting and prudent lending standards. What reason is the FBA giving for saying something that directly conflicts with the White House?
That's an interesting question because most of the other warning signals are coming up to go slow with the addition of fintechs. Yet SBA is, I guess, hanging their hat on the PPP program where they're saying that fintechs were able to reach down into more underserved markets. But the PPP program was not a loan. It was a grant. It was there was no underwriting to it. It was if you made your payroll, you got your loan forgiven. End of story. This is a vastly different program. You have to underwrite it to see whether the borrower can repay and then service it going forward. Probably not something that would be high on the fintech list.
Thank you. Ms. Frazier, I'm greatly concerned SBA is not prepared to handle this. The Inspector General report published March 21 just a few weeks ago noted oversight staffing levels in the Office of Credit Risk Management decreased from 42 to 26 employees, 38%. This staff reduction could affect SBA's FY23 goal for oversight reviews, which helps ensure lender compliance with program requirements. How do questions surrounding the SBA's competency affect what lenders do in the small business that rely on these loans?
Well, as we've talked about many times already today, it's that speed. There is a necessity to gain that access to capital for the businesses in a timely fashion, but not at the risk of prudent underwriting and not at the risk of doing things. But however, if their office is not appropriately staffed, it does put the whole process into
We're out of time. Again, I call on the Biden administration to put a pause on these rules today. Mr. Chairman, I yield back.
The gentleman yields back. The chair now recognizes Mr. Tanadar from Michigan for 5 minutes.
Thank you, Chairman. According to Federal Reserve Bank of Chicago, the small business owners in my district are routinely denied loans due to lower credit scores, lack of sufficient collateral, and lacking access to banking services. In 2022, 2 out of 3 business owners who sought credit did not receive the full amount they requested. To that end, I believe small business owners should have access to more responsible lenders. My question to Mr. Flores is, the SBA has spoken at length about the need to increase lending opportunities for underserved small businesses as the reason for these 2 rules. But nowhere in either of these rules does it state a requirement to lend to small businesses in underserved markets. How do you guarantee that smaller loans are being made and targeting the small businesses in the communities we are all trying to reach? Mr. Force.
Thank you. Again, I referenced the Certified Development Company and its framework and its mission as an economic development set of organizations is our commitment to ensure access to capital, and not only to work with businesses that have been operating for a few years and have a track record, but also those who are trying to get there. And so what that means is being very proactive and engaged, working with the small business development centers that are also part of the SBA network, organizations such as SCORE, and also local chambers of commerce and other units of government locally that are focused on providing programs to help grow that small business ecosystem. The Community Advantage Loan Program is one such program, as well as others. So, a number of certified development companies are Community Advantage lenders. We are committed to continuing that program in our organization, and we believe that there's an opportunity here to continue to grow that initiative. We're obviously open to other ideas, and obviously there's a very robust debate here and concern, and I appreciate that. But I think that there is a way for us to balance risk and at the same time prioritize that access to capital to folks who have been historically left out, and also our rural-based enterprises. There are folks in central and southern Illinois, for instance, who have less opportunities. How do we make sure that those entrepreneurs are left behind? We think programs like the Community Advantage Loan Program can be effective.
Thank you. Now, most of the fraud that occurred during the PPP loan scheme undertaken by the SBA came from fintech companies. I fear without strong oversight regulations, bad actors might fraudulently take advantage of small business owners seeking loans. Ms. Frazier, in your testimony, you state non-bank fintech lending is no substitute for community bank lending. Can you expand on that statement? What services does your bank provide that a fintech cannot?
Well, the basis of a fintech is through the web and through the internet, and oftentimes there may not be even someone they speak to. Answers are given all electronically, and as noted by many of us here, it's about the business plan. It's about being able to sit with the borrower and to speak with them about what are the plans, how do you see this growing, what happens if you don't reach those goals, how will you pay the loan back? And I think that those elements are missing, and I believe in a fintech world, in a community bank world, that personal relationship is there and is guiding them. And if things do go south for a business, and they do, the bank is able to work with them to really help them through those troubled times. And I think that's where the difference belongs.
Thank you, and I yield back.
Next, I now recognize Mr. Crane from the great state of Arizona for 5 minutes.
Thank you, Mr. Chairman. Thank you all for coming today. Last week, I asked Mr. Patrick Kelly, I raised a concern that these rule changes would leave taxpayers on the hook to bail out the SBA. Along those same lines, Mr. Kasar, you mentioned default rates to Mr. Muser. Do you believe these rules will lead to more or fewer defaults on government-backed loans?
It's hard to imagine a scenario where these won't lead to significantly higher defaults because of the complete loosening of controls. And the danger is we won't understand what levers created them because so many levers are being pulled and changed at the same time.
Yeah, you mentioned that a couple minutes ago. If that's the case, sir, who will eventually be on the hook to bail out the SBA?
The taxpayers or the small businesses, because we'll levy heavier fees and count against them to continue the program.
Mr. Frazier, how would you rate the SBA's customer service? Is it easy to get in contact and receive answers from them when a problem arises? Miss Frazier, I'm so sorry. We're not playing some sick joke on you, ma'am. I apologize.
All good here.
They're long weeks up here. Yeah.
I completely understand. Thank you. I believe that having the right relationships within the SBA helps to facilitate quick and easy answers, but it can be difficult at times just given the current staffing situations.
Thank you, ma'am. Mr. Kasar, finally, are you concerned these rule changes could allow lenders to focus more on maximizing their own fees by increased loan volume rather than focusing on quality of loans given?
Absolutely.
Thank you. Mr. Kasar, you said a second ago, you're talking about this crazy science experiment. If we were doing this smartly as an entrepreneur would do it, we would, take one step at a time and then we would evaluate. Is that correct?
Yes, although sometimes entrepreneurs are crazy scientists too.
That's true. We are. But I think the reason that we take one step at a time, if we're being wise and smart and a little bit of cautious, is so that we don't sink the boat. Is that correct?
100%. Lending is you have to think very carefully. There are a lot of levers.
You know why they don't care how many feet or how many elements we take on at one time, right?
I have my theories.
Because it's not their money. It's the Americans' people's money. They don't care. It's obvious. That's one of the things I've noticed since I've been up here. They could care less. It's so easy to spend somebody else's money. That's why this administration just put out a budget. It was another close to $7 trillion. And that's the thing that bothers me about this. My colleague over here, Mr. Thielander, we just came from Homeland Security together. He was talking about, hey, some of my constituents, they don't have enough capital or collateral. Well, maybe they don't need a loan then. Maybe they need to be working on their business plan, to get to a point where they can actually have enough capital, enough collateral, where they can actually secure a loan. Because that's what's going. One of the things going on in this country, we live in such an entitlement country now, where it's like people don't feel like they need to pay anything back.
Yeah.
And who's always on the hook for it?
Yeah, but there's another element to this program which is part of the vicious cycle, which is many borrowers today, particularly underserved, have opportunities on the internet to get money in their bank in 24 to 48 hours. And it's so enticing. Many of them come from fintech lenders, although we have to be careful not to call fintech all at once. And so sometimes they'll get one, and they'll get another, and they'll get another, and it becomes a vicious cycle. And then they come to us and often it's too late to help. So some of the issue that has to be thought about, in my opinion, by Congress is about serving entrepreneurs is what's happening on the other side of the coin. Where are they getting their money today? And oftentimes they're going to the other side because it's simpler and faster. And that also leads to devastating consequences.
Well, what I'll tell this panel is I represent Arizona's 2nd Congressional District. It's a very rural district. We have a lot of hardworking folks in my district. So I know that they probably don't have the same access to capital that, some of these more metropolitan districts do. But all I'll say is as a country, when you're $32 trillion in debt, there needs to be a return to fiscal responsibility, and I just don't see that with this program. I don't see that with these rule changes, and for that reason, I don't support it. Thank you, Mr. Chairman. I yield back.
Very much, and I next recognize Mr. Molinaro from the great state of New York for 5 minutes.
Thank you, Mr. Chairman, and thank all of you for being here. I'm happy that I was here for Mr. Crane's comments because it does, in fact, set up what I think is ultimately the problem. I'm old enough to, although I may not look it, to remember when we were all living fat and happy and encouraging access to capital for home purchasing to underserved communities, and a noble and important goal that led to a mortgage crisis that we have not rebounded from since. And I couldn't think of a less apt organization than the SBA to manage a less restrictive and more irresponsible set of new rules. And this is not me being political. I spent the last 12 years as a county leader, lived through COVID and PPP, and I can absolutely say local chambers of commerce, local business organizations, they all shared the exact same concerns that we're voicing today. The SBA, despite its relationships, despite partnerships with not-for-profits and partners in the community, just is inadequate to do and to manage what they're proposing in these rule changes. And so I want to start, in fact, with the underserved populations, because I think actually the SBA does a reasonably good job partnering to provide access to capital to underserved communities. And so, Ms. Frazier, you spoke a little bit about the lending, the 7A lending program demonstrates strong lending patterns already to underserved borrowers. 1 in 3 7A loans were to minority-owned businesses. So with the SBA's complete overhaul of the program, would you give us some idea how these rules could negatively impact what we already do somewhat successfully to serve those underserved populations? What's the risk that we open with these rule changes?
Thank you. And I think I'm going to go back once again that oftentimes another loan or loan is not what the borrower needs or what the new business owner needs. Oftentimes they need coaching, they need counseling, they need to have a better business plan and work through that. And I don't believe unleashing very loose credit standards is going to be effective to ensuring the integrity of the program, but also ensuring economic viability for the underserved.
And so despite coming from New York State, meaning most people think that's an urban place, I represent rural communities all throughout upstate New York, and access to capital is a concern, and we do have difficulty small businesses accessing. So to your point, what the SBA is doing is eliminating all of, or basically throwing out the guide rails that would protect us in the case of fraud and abuse. And Mr. Wilkinson, you and I spoke yesterday, so thanks for that conversation. To avoid what we know to help avoid the circumstances of fraud and abuse here, what protections or rules should the SBA keep in order to provide the appropriate integrity of 7A lending? And I kind of asked this of you yesterday. What are some of the rules that do make sense that should not be thrown out?
Sure. There's a list of 8 or 9 criteria that are in regulation, that were in regulation, that have been taken out, and we would suggest that those be put back in statutorily. But I want to go back to the previous question and just note that year to date, we've got about 24% of our borrowers who do not note on their loan application a particular race. So our loans to minorities are most likely underreported. We probably have a much better track record than the numbers present.
So SBA doing a better job in recording, reporting, and then transparency. I know Mr. Chairman believes, as we do as a committee, the SBA should be more forthcoming with much of its data. And by the way, I would say out loud, the SBA should be more forthcoming in its interaction with the industry and the development of these rules, which does lend us to some concern and certainly frightens us.
A conversation just like this before the rules were implemented would have been very helpful.
Yeah, I'm concerned about the conversation that the SBA may have had with folks who benefit from the rule changes before the rule changes, but I'm just saying that as a happenstance. Perhaps that may or may not have occurred. Before I finish up, Mr. Kasar, is it a fair assessment to say that without the appropriate regulations and clearly defined requirements, it will ultimately be extremely difficult to determine if borrowers are acting in good faith or not? There are bad actors. They will act badly. That is a known fact in humanity.
100%.
Thank you, Mr. Chairman. I yield back.
Thank you. Next, I want to recognize Mr. Stauber from the great state of Minnesota for 5 minutes.
Thank you very much, Mr. Chair. I want to thank the panel for joining us today, as well as for the important role that you play in supporting our small businesses. Like you, I have serious concerns over the misguided 7A loan program rules that the Biden administration has put forth. As I shared during last week's hearing, the 7A loan program has been instrumental in helping to grow small businesses, which I believe are the engines of innovation in our economy. I'm committed to upholding the integrity and fiscal soundness of this program. Information shared by the SBA in the supplemental guidance and its final SBLC rule indicated that the SBA only intends to give licenses to 3 new SBLCs, and that it expects these 3 new SBLCs to make a total of 425 loans over the next 4 years. However, the final SBLC rule does not contain any limit on the number of new SBLCs that can receive a license. Mr. Wilkinson, how many licenses for non-federally regulated lenders do you think the SBA will actually grant?
Well, that's unknown. In the narrative, they say they're only going to do 3, but in the actual regulatory language, there is no limit.
And what do you expect these new lenders' loan activity to be? Do you think the figures provided by the SBA are accurate?
No, sir, I do not. I think they're low by a significant amount.
Thank you. Ms. Frazier, approximately how many financial industry regulators oversee the operations of a community bank like the Bank of Charlestown?
I actually have 3. I'll speak for myself. We have the state regulating, West Virginia. We have the FDIC, and then our holding company also is the Federal Reserve. So for most community banks, 2 to 3. As well as, aside from that, the SBA does come in and do their own oversight and regulation of what we've done in looking at the loans.
Do you believe the Small Business Administration has supervision and regulatory expertise and bandwidth on par with the comptroller of the currency, FDIC, or Federal Reserve?
No, I don't believe they're prepared for that. Taking on not only just reviewing the credit files for whether or not they agree with the SOPs, but understanding the whole processes, controls, and the way the company, the capital, and the things related to any company a non-bank fintech would have.
You know, during our hearing last week, when I pressed Mr. Kelly, he tried to explain that the SBA will have the ability to provide the necessary supervision and oversight to the non-federally regulated fintech companies that will flood the 7A program under the Biden administration's new rules. This is even as new loan activity far outpaces the unrealistic figures the SBA has provided. Just yesterday, I sat down with a group of small community bankers from across northern Minnesota who shared their concern that the SBA is not capable of overseeing these fintech companies in the 7A program, particularly given the SBA's track record with PPP. And you all know it's approaching $900 billion in fraud and counting. I trust my local community banks to be responsible 7A lenders, due in part to the layers of supervision and scrutiny that they face from several different financial industry regulators. They also live and work in the communities they serve and have deeply personal relationships with the small businesses they help grow and support. I unfortunately cannot say the same of fintech companies. I agree with my local lenders in Minnesota and worry that the uneven, lax oversight of fintech sector entering the 7A program will put the entire program at risk. And I want to thank our local community banks who kept us afloat during the pandemic. Had it not been for our community banks, I believe this nation would be in dire straits today. Thank you. Mr. Chair, I yield back.
Thank you very much. And well, we have a minute to go. I want to just reinforce what my colleague said about the community banks. We've talked about this, but I compare what you all did to what our bomber plants did and our manufacturing plants did in World War II, where they turned around overnight, got our country going. You all did the same thing, getting money injected in the economy that actually brought a return on investment back to America. So I want to thank you for that. I also want to thank you, the witnesses, all of you today, for being here and appearing before us. Without objection, members have 5 legislative days to submit additional materials and written questions for the witnesses to the chair, which will be forwarded to the witnesses. So I ask the witnesses to please respond promptly when that happens. And if there's no further business, without objection, the committee is adjourned. Thank you.